Welcome back. You're still tuned into Midcap Radar. Well, DLF has been in news after the subsidiary of DCCDL, which is the commercial arm, will be selling Kolkata Tech Park to RDB Primarc Techno Park. And this is for over around 600 crore rupees. Mr. Sriram Khattar, the Vice Chairman and MD at DLF Cyber City Developers, is joining us now to take a few questions on this and the commercial outlook generally for the company as well. Mr. Khattar, good afternoon. Thank you so much for joining in. Before I ask you about this sale that has happened in the IT park, I just want to understand the current occupancy levels that you're seeing right now. It has been consistently increasing. What is it right now, considering that we did have the festive season? Was it better than Q2? And what is the outlook for Q4 as well?
So we started the year with a vacancy of about 9%, which at the end of Q2 came down to about 7.5%. And we plan to end the year at a vacancy of 5 to 6% on the commercial offices side. On the retail side, the vacancy has been consistently between 2 to 3%, which will continue because of the normal tenancy churns that keep happening in the retail industry.
Right. And when do the rentals of DLF Atrium Place and the next phase of Downtown, Gurugram and Chennai start coming in? I mean, you typically pre-release your buildings before starting.
Yeah. So I'll split it into three parts. I'll start with the two downtowns first. So the downtown Gurgaon has already got about 1.7 million square feet of operating buildings. About 2 million square feet is getting completed in about 2 months' time, and the rentals for this will start by May, June of next year. The downtown in Chennai, 2 blocks of 2 million are already occupied, rented and operational. And another 1 million, the rentals will again start by May next year. Atrium Place is a project which is about 3 million square feet, out of which 2 million will be ready by April next year, and the rental will start by about August next year. One tower of about 1 million square feet will be ready by end of next year, and the rentals will start by about April, May of 26. Now, this is on the existing assets which are just completed or about to be completed in the next 12 months or so. We have two very large projects that are going on. One is the phase 2 of downtown Gurgaon, which is 5.5 million square feet of offices and 2 million odd square feet of retail. The construction work has already commenced, and we are planning to complete these assets by FY28. And the rentals will start in the beginning of calendar year FY28. Similarly,
Please go ahead. No, please go ahead. Yes.
Similarly, in the Chennai downtown, whilst we have finished phase 1, construction on phase 2 started in the month of June, July, which is likely to finish by 27, and rentals are going to start in 28, and that is about 3.5 to 3.6 million square feet.
Okay, so that's a lot of addition that you're going to see in the pipeline, right? In different geographies. So, in 6 months, FY25, you've done rentals of around 3,200 crore rupees. Say 1 to 2 years down the line, when all or most of these projects also come on stream, you start booking rentals from that. What would the exit run rate look like? What's the target?
So, as we have given it in our analyst presentations, our run rate in DCCDL will be about 5,000 crores as of FY25, going up to 5,800 crores in FY26. In addition to that, there are certain assets, commercial assets, which are housed in DLF and not in DCCDL, where the rentals for FY25 will be in the ballpark of 300 crores, but FY26 will go up to 800 to 850 crores because of certain rentals starting at Atrium Place and the 3 malls coming up in the books of DLF.
So including DLF and DCCDL, by FY26, you could have a run rate of close to around 6,500 crores.
About 5,900 to 6,000. 5,000 in DCCDL and 8,900 in DLF.
All right, take that point. And what about, the SEZs? How much area have you denotified out there? And what's the mark-to-market rentals for these denotified areas? And I just wanted to understand what the incremental percentage from the last rental has been here?
Yeah. So SEZs, we have already denotified about 2 million square feet. Out of this 2 million square feet, about 1.2 million has already been leased. In the Gurgaon area SEZs, we are getting better rentals than in the SEZs. Whereas in Chennai and Hyderabad, where the general stock in the city of SEZ assets is quite large, the rentals we are getting are similar to the rentals that we get for SEZs.
Okay. All right. Mr. Khattar, then coming back to this recent sale that you made in Kolkata, what will those 600 crores be used for? And you also have a land in Pune. So will you be making a comeback there with any more commercial properties?
So this sale which we did was actually, it's a slum sale at 637. But if you add the deposits, etc., the value of the asset is about 675 crores. This has gone to pare down the debt of about 250 crores, which was there on this asset. The balance 400 crores comes to our normal cash flows, which will be used in the construction and growth of DCCDL.
And Pune, yeah.
As far as Pune is concerned, we keep looking at options and opportunities and comparative advantages of whether to develop it or to hold on for some more time. At the moment, we are not finding the rental rates attractive in the location where we have our properties to invest in that at present. But, as you know, land is something which can go sick but does not die. And at some stage, once it comes out and we find it competitive and we find a good ROI, we'll surely develop it.
All right, take that point. Thanks a lot, Mr. Khattar, for stopping by and giving us all those details on your business right now. We'd have liked a longer conversation to get a sense of how retail is doing in the festive season, etc. as well, but we'll leave that for another day itself. Take a short break, come back, focus on the markets, a bunch of individual stocks which are buzzing down.